Welcome to this explainer. Look, if you're a startup founder, you already know that building a truly great product is incredibly hard. But what often catches founders completely off guard is the massive gravitational pull of raising capital. We're diving straight into this today because honestly, fundraising is frequently the single biggest time sink you'll ever face. It pulls your focus completely away from your product roadmap, your team gets anxious, and your runway shrinks with literally every passing week. So we're going to unpack the definitive guide to raising capital, giving you the practical advice, the hard numbers, and a step-by-step strategy you need to totally streamline your next raise.
To really set the stage here, we need to confront a pretty harsh reality. 6 months. That is how long the average Series A takes from your very first investor meeting to actually getting that money wired into your bank account. And some take even longer. When you consider just how fast a startup has to move, burning half a year simply trying to secure cash is terrifying. You absolutely cannot afford to get this wrong.
And that brings us to a stark contrast you see all the time in Silicon Valley and beyond. It almost always plays out exactly like this. On one side, we have the disciplined founder. They run a tight, structured process, they close faster, and they secure way better terms. On the flip side, the winging it founder. They kind of just fly by the seat of their pants, burn precious months, take bad deals, or worst of all, fail to close entirely. Our goal today is to put you firmly in that left column.
Here's our quick roadmap for this explainer. First, we'll break down funding stages and metrics. Second, we'll cover exactly when and how much to raise. Third, we'll walk through a tactical 10-step playbook for execution. And finally, we'll highlight common mistakes to avoid. Let's jump right in.
Okay, part 1. Funding stages and metrics.
I want you to think about these funding stages like leveling up in a video game. Each stage represents a new level, and each level requires very specific stats to beat the boss. If you walk in without the right stats, you're going to lose. Look at pre-seed on the left. You're looking at a $1 to $5 million valuation, and it usually takes about 1 to 3 months to close. Right now, you are selling a vision. Investors are betting on you, your team, and a total addressable market, or TAM, of at least $1 billion. They want to see early signals like waitlists or letters of intent. But as we move to the seed stage, the game totally changes. You're now looking at a $5 to $15 million valuation, taking 2 to 4 months. Seed investors demand MVP metrics. You need to prove people actually want this thing. That means $10,000 to $50,000 in monthly recurring revenue and hitting 15 to 20% month-over-month user growth. Vision alone just won't cut it anymore. You need that early proof.
Now, let's see how this builds as we enter the big scaling rounds. Series A is the prove you can scale round. Valuations jump massively, from $20 to $80 million. Investors want a repeatable model, over $1 million in annual recurring revenue, and 2 to 3 times year-over-year growth. Fast forward to Series B, and valuations are hitting $80 to $300 million. Now you need over $5 million in ARR and massive growth vectors with net revenue retention over 110%, meaning your current customers are actually spending more money with you over time. And at Series C and beyond, you're a proven business approaching a major inflection point. You're commanding up to $1 billion valuation, requiring $20 million plus in ARR, and strict financial discipline, like compliance with the Rule of 40, where your growth rate and profit margin add up to at least 40. The due diligence at this stage is rigorous and honestly unforgiving.
Moving right along to part 2, when and how much to raise. So now that we know the milestones for each level, when should you actually start asking for money? And how do you calculate the exact dollar amount you need? The crucial thing to grasp here is the 18-month rule and the reality of dilution. Basically, you should start raising when you have 9 to 12 months of runway left, or when you hit a major growth inflection point. As for how much, you've got to raise enough to fund 18 to 24 months of operations so you can comfortably hit the milestones for your next round. You build a bottoms-up budget, add a 20 to 30% safety buffer, and then check the math. The math typically forces founders to sell 15 to 25% of the company per round. We visualized a typical 20% hit right here. You're trading a slice of the pie for the fuel needed to make the whole pie massively larger.
All right, part 3, the 10-step playbook. Let's pivot away from the math and get into the tactical execution. How do you actually run this process? Well, we've broken the entire fundraising lifecycle down into 10 actionable steps. Phase 1 is all about preparation. Please do not skip this. Step 1, define your target and timeline. Step 2, build your data room. And check out that timeline. You need to build this 4 to 6 weeks before your very first meeting. Step 3, craft a crisp 12 to 15 slide pitch deck. Step 4, write your investor update memo. And Step 5, build a massive target list. You need over 100 investor names here.
A handful of targets is just a recipe for failure. This is a numbers game that requires a wide, carefully researched funnel.
Let's pause and look at how to actually structure that data room. You want to organize it into 3 distinct tiers, so you aren't overwhelming investors or, giving away your proprietary secrets on the very first date. Tier 1 is shared at the first meeting, just your pitch deck, executive summary, and metrics dashboard. Tier 2 is shared only after they show initial interest. This is where the heavy financial model, case studies, and product roadmap live. Finally, Tier 3 is shared after a term sheet is actually signed. We're talking deep legal docs, customer contracts, and IP documentation. Structuring it this way ensures a really smooth, highly professional flow of information.
Okay, once you're prepped, we move to phase 2, execution. Step 6, get warm introductions. The data is super clear here. Warm intros have a 30 to 50% conversion rate compared to a totally dismal 2 to 5% for cold outreach. It's a game changer. Step 7, run structured, batched meetings to create real competitive tension. Step 8, navigate those term sheets. Step 9, fly through due diligence using that perfectly tiered data room we just talked about. And finally, Step 10, close and announce.
Finally, Part 4, Common Mistakes to Avoid. Before we wrap this up, let's run through a rapid-fire warning list. Because even with a solid playbook, there are specific pitfalls that routinely derail startups. Let's look at these 7 fatal mistakes. Number 1, starting too late when your runway is already in the critical zone. 2, not running a structured process, essentially just winging it. 3, targeting the wrong investors for your specific stage. 4, underinvesting in the data room, which completely stalls diligence. 5, ignoring valuation reality. Asking for a Series B valuation when you only have seed metrics. 6, negotiating alone. Never do this. Always use experienced venture counsel to protect your interests. And 7, going dark after closing. Seriously, keep your investors updated. They are your partners now.
And that brings us to our final thought. Fundraising is a learned skill, for sure, not some innate talent you're just born with. You have the metrics, you know the milestones, and now you have the 10-step playbook. Ultimately, the absolute best fundraise is the one that gets you back to building your product as quickly as possible. So I'll leave you with this question to evaluate your current strategy. Are you running a structured, data-driven process to get back to building, or are you just winging it? Take a hard look at your roadmap, get prepared, and go execute. Thanks for joining me for this explainer.